So everyone talks about volatility like it's a bad word. What does it actually mean in plain English?
Volatility is just how much a price bounces around. Think of a calm lake versus ocean waves. It's a number that tells you the size of those waves, not whether the water is good or bad.
Got it. But how do you measure those waves? Is there a simple formula behind it?
Yes, it's the standard deviation of daily returns. You take each day's percentage change, find the average, then measure how far each day strays from that average. Bigger straying means higher volatility, usually annualized to a percentage like 20%.
So if a stock has 20% annualized volatility, what does that mean for me on a typical day?
It means on an average day, the price moves about 1.25% up or down. But that's just the typical move. Occasionally, you'll see swings of 5% or more. That's the nature of the wave.
I've heard about historical and implied volatility. What's the difference, and why should I care?
Historical looks backward, it measures past price swings. Implied looks forward, it's what options traders expect future swings to be, based on option prices. Think of historical as a rearview mirror and implied as a weather forecast.
And what about the VIX? I see it on the news all the time. Is that the same thing?
The VIX is a specific index that measures implied volatility for the S&P 500 over the next 30 days. It's often called the fear gauge. When it spikes, traders expect big market moves. It's not a stock you buy, it's a mood ring for the market.
So how is volatility different from beta? I've seen both on stock screeners.
Volatility measures a stock's own price swings. Beta measures how it moves relative to the whole market. A beta of 1.5 means if the market drops 1%, the stock tends to drop 1.5%. Volatility is about the stock alone, beta is about its dance partner.
Can you give me a real example where volatility matters more than the actual return?
Sure. Two stocks both return 10% a year. One has 10% volatility, smooth ride. The other has 40% volatility, wild swings. If you need money in a year, the wild one might be down 30% when you need it. Same return, totally different experience.
So how should a beginner match volatility to their own situation?
First, know your time horizon. If you need money in 5 years, keep volatility low. If you're investing for 30 years, you can handle higher swings. Second, know your temperament. If a 20% drop makes you lose sleep, you're over-volatile for your personality.
What's a practical way to use volatility without getting overwhelmed by math?
Use it as a sizing tool. If a stock has high volatility, invest less money in it. If it's low volatility, you can invest more. That way, the dollar amount of your sleep loss stays the same, no matter the stock.
Any common mistake beginners make with volatility that you'd warn against?
Yes, confusing volatility with risk of losing everything. Volatility is temporary price noise. Real risk is permanent loss, like a company going bankrupt. A volatile stock can recover, a dead company won't. Don't panic sell just because of a wave.
So what's the single best takeaway for someone just starting out?
Check the volatility number before you buy. If it's higher than your comfort zone, either reduce your position size or pick a calmer investment. Volatility isn't your enemy, it's your speedometer. Just don't drive faster than you can handle.
That makes sense. So should beginners just avoid high volatility stocks entirely?
Not necessarily. High volatility can mean high opportunity, but only if you have time and stomach. Start with a diversified index fund, which has moderate volatility. Then, as you learn your own reactions, you can add a small slice of wilder stocks. Slow and steady wins.